Can Bitcoin stay above $60,000? Today we are covering a real shift in the macro picture. Soft ADP and payroll data, dovish signals from Fed Chair Kevin Warsh, and a collapse in rate hike odds are all lining up at the same time. Let's get straight into the data. First, the positive news. The odds of a rate hike at the next Fed meeting have been cut in half. Before Warsh spoke, and at the time of my last FedWatch update, those odds had climbed to 33%. Today they sit at just 17%, with 82.4% of the market now pricing rates to stay exactly where they are. That is a major repricing in a matter of days, and it changes the setup for risk assets heading into the meeting. And a quick note before we go deeper. We called this chart to the point inside our Discord, brilliantly mapped out by our chart analyst, Jim. If you are not in the DXB Discord yet, you are missing out. It is just $9 a month, and the link is in the description below. Now let's go through the macro. At the start of the week, we highlighted the importance of Fed Chair Kevin Warsh's remarks at the ECB Forum in Lisbon. Markets reacted positively to what he had to say. To understand why this matters, look at the past month. Bitcoin and the broader crypto market have been caught between two opposing forces. On one side, persistent ETF outflows, negative Coinbase premiums, and cautious investor sentiment have kept price action fragile and directionless. On the other side, several important shifts have been building underneath the surface. So what did Warsh actually say? In his first major public appearance since becoming Fed chair, he delivered a balanced message. He acknowledged that inflation expectations have eased over the past month and stated that inflation risks now appear lower than they did just a few weeks ago. At the same time, he made one thing very clear. The Federal Reserve remains committed to its 2% inflation target, and anyone expecting the Fed to get comfortable with persistently higher inflation is going to be disappointed. The market read this as modestly dovish. The inflation concerns that had been weighing on risk assets have started to ease, and at the same time, other supportive developments are unfolding. Long-term Bitcoin holders have returned to accumulation, and multiple technical indicators are aligning right at current price levels. These three themes, improving macro conditions, Bitcoin accumulation, and genuine on-chain adoption, are starting to converge. The question is no longer simply whether Bitcoin can hold $60,000. The question is whether improving macro conditions and patient capital can finally deliver the sustained demand that risk assets have been missing. Now to the second major catalyst, the US labor market is softening. The US economy added just 57,000 jobs in June. That is significantly below expectations of 110,000 and down from a revised 129,000 in May. This softer than expected payroll report was supportive for risk assets because it reinforces the view that labor market conditions are cooling without any sign of a severe economic deterioration. Here are the key numbers. Non-farm payrolls came in at plus 57,000 against plus 110,000 expected. The unemployment rate printed 4.2% against 4.3% expected. Average hourly earnings rose 0.3% month over month and 3.5% year over year, both exactly in line with expectations. So hiring slowed meaningfully, but unemployment held stable and wage growth showed no signs of re-accelerating. That is the combination the Fed wants to see. Digging into the sectors, June's employment gains were led by professional and business services with 36,000 jobs, social assistance with 25,000, and healthcare with 22,000. The largest weakness came from leisure and hospitality, which lost 61,000 jobs, reflecting softer seasonal hiring and potentially some distortion from the World Cup. Most other major industries, including manufacturing, construction, retail, transportation, financial services, and government, showed little change. Adding to the softness, payroll revisions cut April and May employment gains by a combined 74,000 jobs. Put it all together, and the report supports a gradually cooling labor market rather than an abrupt slowdown. Combined with easing inflation concerns and Warsh's balanced messaging, the data gives further support to the recovery currently underway across risk assets. Best way to approach this is to continue with your bear market DCA strategy. Inflation report will be the key. That is the update for today. If you found this valuable, Hit like and subscribe for daily market intelligence. Join the VIP community at wop.com/DXB for the daily briefs and Jim's chart work. And if you want the same smart money data we use, Nansen with code DXB gets you 10% off. All links in the description. Not financial advice. Do your own research. See you in the next one.